So allow me to read the question. It says, Abel, Benta, and Channel have been trading in a partnership business under the name ABC Enterprises. They decided to convert the partnership into a limited company, Abel Limited, as at 30th November 2019. The partnership financial year ends on 31st May, and the company will continue using the same year-end dates. The trial balance below showed the financial position of the partnership as at 31st May 2020, before making adjustment for the conversion to the company. Okay, so we have capital, current accounts, drawings in cash, freehold property at cost, motor vehicle at cost, furniture and fittings at cost, accumulated depreciation, that is motor vehicles, furniture and fittings. We have inventory, cost of sales, we have sales. There is also administrative expenses, selling and distribution. We have accounting and auditing expenses, incorporation expenses, trade receivables and trade payables, prepayments and accruals, loan from Benta, 10% interest per annum. Then we have bank balance. Additional information: the partners were sharing profit and losses equally after allowing for annual salaries of shillings 3 million for Abel and shillings 2.2 million each for Benta and Charlie. The partners agreed on the following conditions for conversion to a company. Assets to be revalued as follows: freehold property at 54, furniture and fittings at 4.8, motor vehicles at 24. No problem. I think the thousands there was not appropriate. It's supposed to be millions, because if you put thousands, it will not make sense. Sure, it's supposed to be millions. Goodwill to be valued at 27 million. Each partner to become a director of the company at the same salary as that previously allowed in the partnership. Benta's loan is to be converted into share capital at par. Shares are to be issued to each partner at par in respect of the amount of their equity holdings as at 30th November 2019. The sales during the second half of the year after conversion were 50% above that of first half. However, the gross profit percentage remained the same throughout the year. The selling and distribution expenses were proportional to the sales for each period. All the expenses were incurred evenly throughout the year. Salary drawings were made evenly. Drawings made after incorporation were to be treated as directors' salaries. There were no purchases or sales of non-current assets during the year. Depreciation is to be provided on cost per annum as follows. So motor vehicles, 20%, furniture and fittings, 10%. No dividends are paid or proposed, but it is decided to write off incorporation expenses and also shilling 7 million of the goodwill. Goodwill is treated as having arisen from purchase of a business. Required statement of profits or loss in columnar form. Columnar form is the one normally used, not T account. In columnar form, showing separately for ABC Enterprises and Abel Limited. for the year ended 31st May 2020. ABC Enterprises was the partnership. Sure. So they want the profit account for the partnership. They also want profit account for the limited company after conversion. Then B, calculations showing the value of shares to be issued to each partner. Remember, the same partner are the ones which are going to become directors in that new company. Then statement of financial position for Abele Limited as at 31st May 2020. So there we go. So in this case, we have to be very thorough. They want us to prepare two profit accounts for the company, no, for the partnership and for the company. So say there. But before you say, let me say, how is the financial year moving? How is the financial year? Is ending when? 31st? 2020. So for financial year to end on 31st May 2020, it should start when? For it to end on 31st May, it should start on? When you start from group, you check tomorrow. 1st June. 1st June 2019. 1st June 2019. Yes, that is when it should start. Sure. When did they convert to partnership? Because the P&L, we are going to apportion using the period. So when did they convert the partnership into limited? So when they require to prepare P&L for partnership and limited company, when there is conversion, do this, then check the date when they converted. So when did they convert? Note number? Or somewhere there. They decided to convert the partnership where the question started into a limited company, Abele Limited, as of 30th November 2019. 30th November 2019. Somewhere there. 30th November 2019. So when you are preparing P&L, you prepare P&L for partnership for this period, not for the whole year, for this period, then also for company for this period. So how many months are these from here to there? How many months? If you mess the months, you mess the entire question. How many months?
6.
Those are how many months? 6. So these are 6 months. Even this is 6 months. So you will prepare P&L for partnership for 6 months and also for the company for 6 months. There we go. Winfred Pahome, why have you logged in with the 2 devices? Kindly check. So draw this, very important for you. So 6 months partnership, 6 months company. 6 month partnership, 6 months company. Okay. So that is fine. So write for me there. Write for me there. They are called ABC. What? Those ABC Enterprises. ABC Enterprises and Abele Limited statement of profit. Stop what? Loss. For the year ended. The year ended 30th, 2020. So have that. So we are going to combine all of them. We want to combine all of them in one. So you write for me here. You write here. First 6 months. First 6 months. There is no even need of first 6 months. Just write 6 months. 6 months partnership. 6 months partnership. Then the other one is 6 months what? 6 months company. 6 months company. Then you write total. Total, we might not even use it that much. So that way, shillings are in thousands. So in each corner, have shillings in thousands. So each corner here have thousands here, there. This one just have that's there. I will not use the total that much. So have that one there, like that. So if there is conversion and they want you to prepare the P&L for partnership and also for the limited company, then this is what you're supposed to do. Are you ready? All right, now the apportionment will start from gross profit. So I want us to work up to the gross profit. So start there with sales. So sales, cost of sales up to gross profit. I'll tell you why. You work with the total up to the gross profit. I'll tell you the reason. Always not for this, but in any apportionment, start from gross profit. I'll tell you the reason after we're there. So how much was sales? How much was our sales? The question. Sales was 100 and what? 20. So you give us here 120. So you work up to the gross profits for every question which requires apportionment for reasons which I'm going to tell you shortly. So 120, then you less cost of what? Cost of sales. So less cost of sales. Cost of sales is how much? 6,800. 6,800. So you subtract. What you get is the gross what? Gross profits. Gross profit. So, guess that. Need gross profits. So gross profit comes to how much? 59. 59, 200. 59, 200. Very good. So now, the reason as to why we are always required to start apportionment from here. You know, cost of sales. What are the components of cost of sales? Opening stock, purchases, closing stock. There is no way you can apportion stock with the time. But you say stock, half stock for 6 months. No. Assets are never apportioned. You remember when our balance sheet in group, we don't apportion what? Assets. So cost of sales brings an issue. Sales you can apportion, no problem with sales, but cost of sales cannot be kind of apportioned because it comprises asset, which is what? Stock. So we are always advised to work up to the gross what? Profit. So once you are at the gross profit, you can start the apportionment from there. So how do we apportion the gross profit? I would comfortably apportion it in the ratio of half 6 months, 6 months. But the examiner said something which is very critical in note number 3. Check additional information number 3. Additional information number 3. The sales during the second half of the year. Second half of the year is this one, after conversion. We have 50% more than that of the first half. However, the gross profit percentage remained the same throughout the year. Gross profit percentage, gross profit is apportioned the way you apportion what? Sales. So if that sentence was not there, I would have taken 6/12 to 6/12. But they are saying that sales in the second half was 50% more than this side. So it means sales was not uniform. So you cannot say 6/6. So I want to check the ratio. So the ratio for sales is always the ratio for the gross profits. Because if this is 80, cost of sales is 20, then this. So gross profit, you apportion the same ratio as what? As sales. So sales, they were saying sales for the second half was 50% more than the first half. And we don't know it is how much. We don't know the first half, we don't know the second half. What we know is what? Total, which is 120. So you say, let sales in the first half be X. Sales in the first half to be X. So if this one is X, then they are saying this side is 50% more than this. So this side will be, from your mathematics, if this is X, and this side is 50% more than this side. So here will be, am I justified to say 1.5? Because 50% more is 150%. So 150 is 150 over 100 is 1.5. So it means this side is 1.5x. So to get the total, and you know the total they have said is 100 and what? 20. So it means x plus 1.5x is equals to 120. Can you give me the value of x? Can you give me the value of x? What is the value of x?
48.
X is 48. So if x is 48, this other side is? If x is 48, mathematicians, now that is not accounting. 48, 72. So the other side is 72. So how was the sales ratio? The ratio for sales is the ratio used for gross profits. So the ratio is 48 is to what? 72. Can you scale it down? By 24? 2. By 24? 3. So the sales ratio was 2 is to what? 2 is to 3. And that is the ratio you are going to use to apportion the gross what? Profits. Please master this. These are some of the potential questions they can repeat. So, is there, let me not rush, is there someone, maybe, let me just repeat if there's somebody who has not understood this concept. they said total sales for the period is 120. So in that case, what you need to understand and appreciate and believe is that the ratio for sales is the ratio used for gross profits. If that note was not there, I would have taken half, 6/12, 6/12 for the apportionment. But examiner complicated issues by saying that the sales in the second half of the year was 50% more than the first half. So it means I must get the ratio for sales. So I've assumed here was X. So if this is X and here is 50% more, it means it is X plus 50% of X, which is X plus 0.5 X. X plus 0.5 X is 1.5 X. So here is 1.5 X. So this plus this gives you 120. So you are the people who have computed the value of X, 48. So sales is 48, here is 72. So the ratio is 2:3. So this is the same ratio we are going to apportion the gross profit. So can you apportion for me the gross profit in the ratio of 2:3? In the ratio of 2:3. Apportion for me that in the ratio of 2:3. How much? So 2/5 times 59, 200. 3/5 times that. How much do you get? The first one is 23? 680. Then, so you put it in the N column. Please let's obey that. Don't. This other one? 35? 520. Thank you. Now from there, we go with the expenses. Expenses, unless otherwise stated, you take half. 6/12, 6/12, half. Unless they restrict us somewhere. So let me check where we have been restricted. Number 4, they restricted us in note 4. The selling and distribution expenses were proportional to the sales for each period. All the other expenses were incurred evenly throughout the year. So it means the others uniform, half. But selling and distribution, you use the same ratio as sales, which is 2:3. So say less expenses. So expenses top down. So we come from top to check those expenses. Capital, no. Current account, no. Drawings, no. Freehold, no. Motor vehicle, no. Furniture, no. Accumulated, no. Inventory, no. Cost of sales, done. Sales, done. Admin. So you give us admin expenses, half. Then, hold on. Total, I don't need total anymore. I don't need the total anymore. Complete waste of time. So total, you can even close it there. We don't need it. We are now concentrating with the two. We were only using total to get the sales via portion, so it will not be relevant for us. So admin, how much is admin? It is 12, right? Half. 6. Proceed. Selling and distribution, S&D, 2:what? 2:3, because that is the direction which was given. So 2:3. Selling and distribution is 6,000. So apportion 6,000 in the ratio of 2:3. 24:36. 24:36. Very good. Accounting and auditing. How much? 12. Incorporation expenses. Incorporation expenses, speaking, we don't incorporate partnership. We only incorporate a company. Sure. So all incorporation expenses charged to the company, not partnership. So that is how much? 12. Trade receivable, no. Repayment, no. Loan from Benta. You check it later. Bank. Not one. The partners were sharing profit. Those things later. Those sharing and salaries will come later. Not two. The partners agreed on the following conditions for conversion. Assets were to be revalued as you guys can see. Goodwill was to be valued at 27. Each partner to become a director of the company at the same salary as that previously allowed in the partnership. So director salaries. Directors salaries. Director salaries. So director salaries, they were not very clear on this thing. Because if you check note number 5, check note 5, check for me note 5, they are saying salary drawings were made evenly. Evenly means uniformly, equally, proportionately. Drawings made after incorporation were to be treated as directors' salaries. Drawings after incorporation were to be treated as director salaries. How much was the drawings? So check drawings. Drawings, are you seeing 2,000? In the trial balance? Yes. 2,000 plus 12 plus 12. But you see this one was for the whole year. That's what they were saying proportionately. Because for directors will be captured this other side. For how many months? 6 over 12. Partners are not paid it here. They will be paid in appropriation account. So how much? You're saying how much? 32? You've taken 6 over 12. When you apportion, why are you feeling your life? That's 32, doesn't sound smart. 12 plus 12 is 24. 24 plus 2 is 54. It's 2200. 12 plus 12? 24. 24 plus 2? 44. 44 by a half? 22. Thou shalt not mislead elders. Which percentage? So 22. Well, there's something we have skipped, but it is disturbing my heart. So I want us to finish it up. There is this second. Yeah. Okay. There is this second last item in the trial balance before we go far. Loan from Benta. Benta was a partner. Sure. She gave a loan, and the loan was attracting interest at what rate? 10%. Let's check that interest. So, interest on loan, interest on Benta's loan. Benta's loan. How much was the loan? 12. Sure. 12. So 10% of 12, but 10% is per annum. So you charge 6 over 12. Tell me the figure. 600. That one you only charge in partnership. Here, we don't have partners. We compensate themselves there. Let's proceed. Let's proceed. Each partner, that is done. Vendor's loan is to be converted to share capital, fine. Shares are to be issued to each partner, no problem. Note 3, sales done. Note 4, selling done. Note 5, salaries done. Note 6, there were no purchases or sales of non-current assets during the year. Depreciation is to be provided as otherwise is capable of seeing. So let's charge depreciation. So depreciation, let's charge depreciation. Let's charge depreciation. So depreciation, motor vehicles. I want you to be very keen and careful. Motor vehicles, check trial balance. There is motor vehicle at cost. Are you seeing that? Check note number 2, additional information number 2. The partners agreed on the following conditions for conversion to a company. Assets to be revalued as follows. Motor vehicles to be revalued to how much? 24. So in our depreciation, for partnership, we depreciate what is in the trial balance. In the company, we charge the new value. Are we together? Because they were taken over, the company took them over, the values appearing in note 2. But the company, the partnership was to depreciate this one here. So motor vehicle is 20, they are charging depreciation at what rate? 20. So 20% in brackets, 20% in brackets. For partnership, 24, eh? So 24, comma, the other side, no, not even comma. Just have a comma here. The other side, the same. 24. Okay, no problem. But in each case, make sure you take 6 over what? 6 over 12. It was 24. So what you get, 6 over 12, 6 over 12. The accumulated depreciation will not be a concern because they were charging on costs. So you don't subtract unless it was reducing balance. If it was reducing balance, you subtract the accumulated. How much? 24. 2400. You've taken 6 months. 24. Let's do the same for F and F. F and F, 10%. Partnership, in the trial balance, F and F was 12. The other side, it has been taken over at 48. 6 over 12. So this by this, 6 over 12. This by this, 6 over 12. Tell me what you are getting. $600, and the other side. Yes, it's better than 400. So 600. Then the other side is 240. Let's continue reading. Let's continue reading. No dividends. Note number 7. No dividends are paid or proposed, but it is decided to write off incorporation expenses. To write off means you expense. So incorporation expenses we have already written off by treating it as an expense. And also 7 million of goodwill. Goodwill is treated as having risen from purchase of business. So goodwill written off. Goodwill written off. So you can't write off here. It will be written off after the purchase, which is how much? You've said? So 7,000. Yes, 7,000. Full stop. There is no any other expense. So can you add for me? Do this. Add all these expenses. Bring it here. Add this. Bring it here. Then we get net profits. So I want everyone to tell me the net profit. I'm not interested in the totals. Tell me the net profits here for each side. Tell me the net profits. Yeah, I want the net profits. Eh? Net profits. How much? 10?
480.
11,680. For the company, funga kabisa na usahau. Close and forget about it. Close for the company and forget. How are we going to treat partner salaries in Note 1? Now that is where we are coming, John. Partner salaries is not expense. I hope you are aware. In partnership, we don't charge partner salaries in the, yes, we charge it in appropriation. Eh? So right here, appropriation account. Appropriation account. So in appropriation, you bring partners salaries. So partner salaries, we have, it is in Note 1, check your Note 1. The partners were sharing profits and losses equally at allowing for annual salaries of 3 million for Abel and 2.2 each of Sam. So Abel, 3 million is per annum. So for 6 months is 15. So 3 times 6 over 12, 15. Then we have Benta, 2, 6 over 12, that is 1100. 1100. Then Charlie, also 2, 6 over 12, 11. Add. How much? 30? 100. So how much is remaining? So what remains is what they are going to share. How much is remaining? 10 for 80 minus 37. How much do you get, people? 67? 67, 80. Share that profit. So profit share. Profit share, Abel, Benta, Charlie. What was the ratio? Where's the ratio for sharing? Or read Note 1. The partners were sharing profits and losses equally. Equally means 1:1:1. So 1/3. 1:1:1 is 1/3. So divide this by 3. Give everyone here equally. Then bring here, subtract, you say nil. Then we adjust the current accounts. So you come up with current accounts. Current accounts. So partners' current accounts. Draw that. Draw that. Then you insert these ones. But balance brought down, there is one which is negative for this one. We'll try to bring those balances. Try to bring those balances. Sam, help me with the answers. Here, first of all, they shared how much? 2260, 2260, 2260. Let's come here to the current accounts. Any moment you have appropriation, you must adjust current account. If current account is not in the question, you adjust them in the capital account. So what was the balance brought down? 2, 2, but this other one is on this side. So for Charlie here, I hope you have captured that. Sure. It is on the debit. And even I told you, and I brought it here. Partner salaries are here. 15, 11, 11. So 15, 11, 11. Profit share, 2260, 2260, 2260. Sure. Then drawings will reduce the capital. Where are the drawings? Where are they? Draw is 2, 12, 12, but you know, half of it became salaries in the limited company. You remember? The director salaries, half of the drawings, you remember? It became salary. So here, divide by half, half, half. So 2 becomes 1, 6, 6. I think that is all. There is nothing. So give me. So the balance which you will get here, you will close to capital. Capital. Online, I want answers. I want those answers from you to capital accounts. Then we prepare partners' capital accounts. But before that, there is something we are going to do. So how much? Patients and others, 4760. For 760 also, they are the same. The first two are the same. 4760, 1760. You have the same?
I think they are not the same.
Yeah. Only 2000 plus this, 35 plus this. 2000 plus what? 2000 plus 11 plus 2260 minus 600. Wewe unafikiria bali. Weka hapo. Anybody with a question there? So I want us to prepare partners' capital accounts. Why am I interested in partners' capital accounts? Read note number, read required B. Read required B. Calculation showing the value of shares to be issued to each partner. So to get the shares, you prepare capital what? Account. Please note that and note that keenly. When you are asked shares, prepare partners' capital accounts. Aye. So have there partners capital accounts. Partners capital accounts. So walikuwa na jina gani? Abel, Benta, Chala. So have that. So balance brought down. How much is the capital balance brought down? So balancing figure in capital account is the shares to be taken there. So any moment, even in the exam which is coming, if they tell you to get the capital, the ordinary shares, just prepare partner's capital account. And they will mark the entries leading to that. Sure. Yes. So balance brought down capital 32, 16, 10, current accounts. So the balance we got in current account, bring them here. So current account, 4760, then 1760, like that. Then there was this note, check here, note 2, bullet 1, 2, 3, 4, bullet 2, bullet 4 of note 2. Bullet 1, 2, 3, 4 of note 2. What did they say? Benta's loan is to be converted into share capital. So she will claim her loan. So Benta's loan. How much was Benta's loan? Benta's loan? 12. Yes. So it will be part of our claim, which will form the balancing figure here. Then bullet 2 of note 2. Goodwill to be valued at how much? 27. If goodwill is valued in the books of the partnership, then you share it to the partners, because they're the people who created that goodwill, the reputation of the company. So you share. So goodwill, share that goodwill in the ratio of 1:1 for all the partners. 27 divided by 3? 9. Sure. So 9. So the only thing remaining, which is going to take our time, bullet 1 of note 2, assets to be revalued. So you know when they revalue assets, in their books, there will be revaluation gain or revaluation loss. So revaluation gain loss will be shared to the partners. So I have to check revaluation on all these assets. I determine whether they were loss or gain. Then we work from there. But I can be very smart. Yeah, by the way, I can do it without wasting time. Will that work? Yes, it can work. Yes, that one can work. Yes, check here. I have a small working down there. But I also wanted to do revaluation account, because there was a question in 2015, you were told to prepare a revaluation account. Though there's a way I wanted to shorten it, fine, it will work, but what if you are asked of revaluation? Let me just go the long way to prepare even the revaluation account in case you are asked. So I want to go one by one. So I have a working down here, we call it revaluation. So what was revalued? The first one is freehold. What was the book value of freehold? And listen to me, book value will be the cost minus accumulated depreciation minus depreciation. You know depreciation, we have two of them. There was here and here. So you check depreciation in this first phase because revaluation was done here. So you check the cost minus the accumulated minus for this period up to the date of conversion. But freehold, there was no depreciation. So now, freehold, let's start with freehold. For freehold cost. The cost of freehold book value was 51,600. Revalued amount 50, 54. Is this a revaluation gain or loss? Again, it has gone up. This is a revaluation gain. So revaluation gain of how much? The difference is how much? 24. 24, 34. 24. I just hold it. Go to, so that is 1. Go to F and F. F and F, what was the cost? So show it like this, just open a bracket. What was the cost of F and F? 12, eh? It was 12. What was the accumulated depreciation in the trial balance on F and F? 72. How much depreciation did you charge up to the date of conversion? Check up to the date of conversion in the P&L. In your P&L. In the P&L. I hope we are together. The cost was 12. Accumulated in the trial balance was 72. Then in your books, how much was there up to the date of conversion? You know, when I see your books, you are feeling the perspective. Up to the date of conversion, F and F we charge 600 because renovation is here. Good. So I was showing someone something there. It was 600. So it means the book value was 4,200. 4,200. How much is the revalued amount? Revalued amount. Revalued 48. That is also a gain. A gain of how much? Revaluation gain of how much? 600. Let us analyze the last one, motor vehicles. So I want you to do for me motor vehicle. Maybe I'm going to ingine. Unifanyie motor vehicle. Then I want to answer there online. Motor vehicle, you tell me gain or loss of how much? You got again loss, and if yes, by how much? Online people are saying 96, 96, 96. Again, eh? So 96 is correct. Irene is answering John. John, Irene is telling you check statement of P&L under depreciation. Yes, yes, depreciation for the year. The same, you can use the same concept here. Motor vehicle, the cost was how much? The cost was 24, accumulated 72 during the year. So John, during the year, check P&L. You have P&L in the, yes. P&L we charge depreciation of how much? 2,400. Eh? That one gives you 14,400. Revalue to how much? 24. So that is how people are getting is a gain of 96. So prepare something down there called revaluation reserve account. Revaluation reserve account. Revaluation reserve account. So John, I hope you saw that. All right, so when assets gain value, you debit the asset, you credit which account? Revaluation reserve. So freehold, it was a gain, so credit the reserve account. So freehold, so if you're told to prepare a revaluation account, you credit it with the gain, then you debit with the loss. So freehold, there was a gain of 24. F&F, also there was a gain of 600. Motor vehicles, there was a gain of 96. Then add this total revaluation. Total revaluation is how much?
12,600.
12,600. So you share that 12,600 to the partners in their capital account. So capital account, they are the people who ensure these assets are getting value. 12,600. The ratio is 1:1:1. So share them equally. 12,600, 12,600, 12,600. 42, 42. Like that. So in case you are told to prepare evaluation accounts, I've seen that in partnership. This is what you're supposed to do. So I take it there to the partner's capital account. You say revaluation gain 42. But what if we were having one loss? You would have debited here, then you get the aggregate. The aggregate can be a gain. You cannot have gain and loss at the same time. You get aggregate, you take the gain minus the losses. So ikibaki loss, sawa. Ikibaki gain, sawa. So gain you credit here, loss goes the other side. Sure. All right, so 42, 42, 42. There is nothing to be debited. So the balancing figure is the ordinary shares. Ordinary shares. Balancing figure. So that is how we get the ordinary shares. Can you add and tell me how much for each person? Add and tell me how much for each person. We are finishing now. Balance sheet will not take us long. Balance sheet will not take us long. Calculate for me that first, then you give me the answers. So how much is capital for each partner? How much is capital for each partner? 49?
60.
960?
45, 960.
45, 960?
460.
24?
96.
Can somebody confirm? Online, can someone confirm those figures? Someone to confirm, then we proceed. Anybody with the same answers? Yes, President, so many people are confirming, then that is perfect. So you can say down there, no, not a mass, but you can say down there, total shares. You add these ones. So the shares, remember, is what is going to the balance sheet. So you add this plus this plus this. Yes?
120.
120. Thank you. Let's prepare the balance sheet, then we finish that question. You see this question can come. Right there. The new company was to be known as, so right, a very limited statement of financial position. So, as a friend? Breakfast? So how much? So, non-current assets, let's start. So listen to this. Non-current assets record the taken over minus depreciation after. Now we are going for depreciation on the second phase. So right there, non-current assets, freehold property, freehold property, 51,600 minus 51,600 minus was there depreciation for freehold? No, sorry for that. That one we just take the revalued amount. Revalued amount is how much? 54. It was transferred at 54. Sorry for that. I think my head is heading. 54. F and F, the taken over value is 48 minus depreciation in the second phase. It was how much? Let me see from online. How much was depreciation the second phase? Someone online? The second phase, how much was depreciation? 240. Kabiga? 240? 240, 2400. No, to go for F and F. 240. So 48 minus 240. 23, 7. Huh? 760. What are you getting? It cannot be that. What is that? 45, 60. Motor vehicles is 24 minus depreciation for motor vehicle 2400. Subtract 21,600. There was goodwill. You remember goodwill? Goodwill was taken over, but it was 27. But they wrote off. You remember goodwill written off? 7,000 million. Eh? Yes. So they remained with the 20. There was goodwill which was written off 7. So we remained with 7. Give me that total. Hmm? 100 and 16. 160. Current assets. So current assets just go for the book values. They were taken over at book values. Book values, inventory. I always like starting with inventories for reasons which I don't know. Inventories, there is nothing to adjust. 20 what? 28,800. Receivables. Receivables is 18. Prepayments. Prepayments is how much? 1. Then there is nothing. Can you add? Add that one. 20? 47? 800. Total assets. Like that. Equity and liabilities. So in company, you don't call partners with their names. Eh? You just say shares. So ordinary share capital, we've gotten how much? 120, 880. Retained earnings or net profits. How much was the net profit in P&L for the company? Go to the second half. Check for me the profits. 11? 11,680. I hope everyone sees that. 11,680. There is nothing. Can you add this one? Yes? 132. 560. Current liabilities. I like starting with payables. How much was payables? Kuna mark? Payables ni ngapi? Iko wapi hapa? Hiyo ni overdraft. Siku huko kwa credit side. Siku kwa credit side. Thank God. Hata sikuwa nimeiona lakini naona iko kwa credit side. So payables is how much? It is 600 ama ni 12? Yes, it is 12,200. Accruals ilishikanishwa na prepayments. Is together with prepayments how much? 600. Then bank overdraft. Bank OD. That bank balance, it is appearing on the credit side. Yes? How much is that? 2,000. Then you remember Bentas loan. It was attracting interest. But you know there is no way we were told it was paid. We just expensed, but we were never told whether Benta was paid the interest. So accrued Bentas loan interest, accrued, let me write it here well, though you can write down there, accrued interest on whose loan? On Bentas loan. How much was it? We calculated, just check for me in the P&L. It was? Check, just check. It was after taking half. It was 600. Eh? Okay. 600. I hope so. Can you add? Who add for me that? Add. Add for me current liabilities. What do you get? How much? Huh? Are the current liabilities? Current liabilities. 1,500. So if you add the total, it goes up. 147, 960. Correct. That is it. These are some of the very potential questions in conversion which you need to take good care of. Instead of you working with the encyclopedia, reading so many things, if you want those conversions, you just revolve on these questions. They normally bring them in, I think, in 4 different ways. The one we did, this one, there's another one, there's another one. Once I do those 4, if you want to do partnership, you just continuously do those ones. Because even if you read encyclopedia, you will not get 100% in that question. If you repeat these ones, there is likely you will get 16, 17 over 20. That's enough. So you just continue. So the one we did was just the normal. There is that of Chanda, Pete, and Tender. That is the normal conversion. Then these ones are quite unique ones. So you just continuously do these questions, continuously. Where they need P&L, you apportion. Then you just follow the procedure like that. Thank you. We will meet in our classes, and thank you for coming, by the way. At least this question was long. So we have moved. We have moved, and all classes by next week will be done with partnership. Because my target is 4 questions. They are, some are remaining even with 1, evening are remaining with 1, and morning remaining with 2, day also remaining with 2. So we'll finish next week. Then we go to, I'll decide whether we go to cash flow or we go to published, either of those 2. So thank you, have a nice weekend, and we meet next.